Hello, welcome, and today I'm going to talk about CLM, which also can be used for CRF, which is the sister fund to this. These are closed-ended funds, which are not like ETFs. I'm going to show you how you can retire using this, as well as some other diversification. But as you see, this is diversification itself. So here we are on Morningstar, and as you can see, it's going up. That's a good sign. This is the actual price, this light blue. This is the NAV, or this is the index. This is the NAV, the dash lot lines, and the category, that's, that kind of thing. So it's doing better than the index. The index, of course, is all the stocks. If you're beating the index, you're doing very good. That's the gold standard in investing, is doing better than that yellow line. And it clearly is. But if you go over here, okay, we go to Robinhood. We can just use this 5-year view here. Or we can go to here. There's all the websites have something about it. Very good when you look at it like this. We'll do 5-year. Now look, see, it's up here, trading at 1330, and then it goes down and down and down, and it's kind of waggling around. This is the actual price of the stock. You might look at this and say, this is a terrible investment. I'd rather just save in cash, right? Well, you'd be missing out on money. So it looks bad, right? But is it bad? Well, you have to factor in a couple different things with CLM and CRF. They have they're the same company. They just have slightly different portfolios. So let's see what they have first. What is it made of? What's in the fund? Is it performing so bad because it's investing in just stuff nobody wants? No. Let's see here. So it's got some securities, a little bit of this, energy, not too much, global. Okay, preferred stock, a little 1%. Okay, some of this, real estate, that's not much. Let's see, utility 1.2. Then we go down here. Common stocks. So these are normal stocks. 86% of it is normal stocks. Alphabet, that's Google. That's one of its biggest holdings. Comcast, Meta, Netflix, T-Mobile, Walt Disney, Verizon, eBay, AutoZone, Amazon, one of the biggest ones there. Let's see, a Tesla, that's another big one. Let's see, another big one, Walmart. Okay, that's pretty good stock. Exxon, that's a pretty good stock. Bank of America, that's a good stock. Berkshire Hathaway, another good stock. JP Morgan. If you look through all the stocks they own, all the ones, especially the biggest ones, are high-quality blue chip stocks that anybody would want to own because they're not going anywhere and they have historical proof of record. They're huge companies, right? Eli Lilly, one of the biggest companies in the world, right there, right? Look at all these. These are all good companies. General Electricity, Uber, right? And some are bigger, some are small. Here's two big ones, Microsoft and Nvidia. I mean, if you know anything about investing the past couple of years, these are, especially Nvidia, has been taken off. So it's not made of junk. It's made of good stuff. These are good stocks. Stocks you want to own. Stocks you would be proud to have. If you had this as your portfolio, just this, people would say that's a well-diversified, well-thought-out, good portfolio that makes a lot of sense and should have good yields. So why does the stock look like this? Right. Well, it's because they give you 21% dividend yield at total if you do the drip at NAV. Right. So here we go. That's what it actually looks like when you factor in the dividends. Dividends, of course, are the money that they pay you to own the stock every month, around the 15th-ish. It changes every month. By around the 15th, middle of the month, is the DivX date. If you own the stock then on the next first of the month, sometimes the 31st or something, around that area, you'll get paid a dividend. And the dividend in this closed-ended fund is set every year. So it's not um, varied like you would for a normal ETF, right? It is the same every month. Every month you get the same dividend. Let's see. How much did it pay? Every year they reset the amount, right? So last year it was 10.8 cent for every share you own every month, guaranteed. This year it was a little bit higher, 12.2 cent, right? It also drips at the NAV, which is an important distinction. This is where it really shines above and beyond a normal fund. There are other similar such funds that have good stocks in them that you could buy. But why would you buy these? Well, it's the drip of the NAV. So we'll go to the website for them. Right? This is the CLM website. What does the NAV say? NAV, which is the net asset value. So all those stocks you just saw, this is how much they're all worth together divided by the number of shares. It's worth this much. But it costs this much. If I were to go on to anything, Fidelity, right, and buy it, I would be paying this much for the stock. But the dividend, the money I receive every month, does not buy the stock at this price, right? It buys it at the NAV price. I'm paying $6.81. I can sell it the next day for $8.36, which it varies. But here, right here, today it's about 22.76% difference. It varies. It goes up and down. It can go up to 30s. It can go down. It depends. They also have the rights offering, which is a little, we'll get into in a minute. But if it just does this, if it just drips at the NAV, consistent dividends every month, then that is a great thing to hold. But wait, there's more. Not only do you get consistent dividends, not only is that high percentage, not only does it drip at the NAV, not only does it outperform the market and have solid holdings, investments that anyone should want in their portfolio and is diversified, but they have a rights offering. Rights offering means that it's a complex closed-ended fund thing. Please look it up yourself. But basically, what it means is they only have so many shares. So to create new shares, they have a rights offering about once a year. It varies. You'll have to pay attention. This isn't a stock that you buy and hold and just sit down. You have to actively manage it a little bit, mostly around this rights offering. So if you can get around the rights offering, it says, oh, we're going to have a rights offering. You sell it immediately, and then it goes down, and you buy it again, and then once the rights offer is over, it'll go back up. So basically, they tell you it's about to go down, so you sell it. Then you buy it when it's down, and then that lets you have huge profits in addition to the monthly dividend and the drip at NAV. DRIP, obviously, is the dividend reinvestment program. It's where every month, instead of taking that money that they give you and putting it in your pocket, which you can do, it's better to drip it. And even if you're going to sell it the next day, it's still a better idea. However, there's only two brokerages that I know that do the drip at the NAV thing automatically. And that's E-Trade and Fidelity. You can buy this. You can now buy this stock on Robinhood. You used to not be able to, but you can buy it on Robinhood. The thing is, it doesn't have the drip and NAV. So you'll get the dividend, you'll get 12 cents. But if I do it, right? So it's go over here. Okay. If I do it, 22.76, so that's how much difference I make in the difference. So if I bought one share, right, and I get my, right, 12.4 cent, but then I times that by adding this, so times 1.2276 equals, I get 15.22 cent. instead of just the 12. So I'm making even more money just by having it in Fidelity or E-Trade as opposed to Robinhood. Now, Fidelity has higher margin rates and Robinhood has lower, so you might want to consider that. But as you can see, this can be a very good investment. But wait, there's more. You see, if we look here, this is the NAV price. This is the actual price you can buy it on the market. It tracks pretty one for one, but not exactly one for one. See, premium, discount, average things. You can do these. You can look at these charts, and they'll tell you, okay, this is the price I'm paying for it. This is the NAV. If I can get it where these two are closer and then start selling when they're farther apart, I can get even more gains. Because when they're closer, that means that this is, it's selling at a premium. It's selling for more than it's worth. So if I'm buying it near closer to what it's worth, I can sell it for more than what it's worth. If I want to sell. Obviously, there are advantages to not selling ever. You can just have this in your account, and it just keeps racking up with that dividend reinvesting. You just never sell it. And it'll have return on capital as part of your interest gained, and that will help you to just have a higher account balance from which you can borrow margin. It can offset losses in other accounts. Cornerstone can be a basis. You could have half your account in this, in Cornerstone. In a stock that looks like this, you can have half your account in this, right? And still be making out like a fat cat. Now, here's the trick that I didn't quite think about, whatever. This looks bad. And you might be thinking, well, wait a minute. Back here in 22, it was $14. If I did the math and it's only $8.25 today, right? Then if you add all those dividends, 11 cents, that's not enough money. But the dividend is reset and every year to equate for that. So here we have, this is VU, the orange is VU, and this is CLM. VU, of course, is the S&P 500. So this is the normal market. This is all the stocks basically put together. This is the gold standard, what you want, basically. It looks like it's doing under. This is not including the drip at NAV. This is not including the rights offering. This is a 5-year. It's not including the rights offering, where you know to sell here and then buy here. You can see how it basically tracks that anyways. But this number is misleading because it doesn't include the drip at NAV. And that doesn't include you knowing these other things and being able to play this system. The key here, beyond what some other YouTubers might give you about CLM and CRF, is not only all those great things, but I believe there is an arbitrage opportunity, which is music to anyone who knows what they're talking about here, for doing these NAV. See, here's the NAV price. Here's the NAV. This is price NAV. You can see how right here would be a great time to buy. How would you know that here's a great time to buy? You know because it's close to the NAV. So you're not afraid here. I'm afraid up here because it's so far away from the NAV. So I know to sell it. When it's close to the NAV, I know to buy. It erases fear because you can see how close it is to the NAV. The biggest rule to investing, the gold standard that will help you sleep at night, is to only buy low. Buy low. You can buy it today, but buying low is always better because when it drops down, you won't be as afraid because it won't even be at what you bought it before. So it allows you to weather storms. So saving up your nickels and dimes for when everyone else is selling right here and buying it here means that if you had bought it here for $6.50 and right now it's selling for $8, that's not this chart. This is very misleading. This makes it look like the worst stock in the world, right? This is terrible. No, you use the NAV to price difference, which is on their website every day, right here. Use this. If this gets too high, 22 is kind of middle-ish. When it gets like 30, sell. When it gets to 10 or less, buy. That's it. You don't need to know about rights offerings as much if you do that, because it kind of tells you. But you don't need to know about, the Fed just raised interest rates. Oh, COVID hit. Oh, this, that, whatever. Doesn't matter. Are these stocks going to fail? Is Amazon going to fail anytime soon? No. Maybe some of these might fail, but anything that they have that is even slightly likely to fail is in a lower percentage. And I mean, what's this? Nike? Oh yeah, it's going away real soon. No. These are good, solid companies. It's not going anywhere. So you're buying solid companies, right? You're buying good stuff. Stuff that you want. Pepsi, yeah. Pepsi's not going anywhere. Sorry. Even if like, I can't even think of anyone that would go under. These are all excellent companies. But even if one were, all the rest make up for it. Right? So unless the entire economy explodes to the point where money is worthless anyway, so what's the point of warring? You buy a gun. Outside of that, outside of apocalypse time, right, it'll go back up. And you get a consistent dividend every month, so you can eat off of that. So if you invest money into this, so let's see here. Let's say I have $25,000 and I use margin. So that's double it, right? So $50,000. Okay, so I buy this, and today it's trading at, let's see here, what's it trading at today? 833. Divided by 8.33. How many shares I get? I get 6,000 shares, let's say. Let's say I buy 6,000 shares today with $25,000 plus the margin, right? Okay, and let's go over here. Dividend 0.215. Okay. Times 0.1215 equals, this is how much you make every month just off of $25,000. Which means this is close to $1,000, right? $25,000 every month. That means you're making, times 12, you're making this much a year, right? So over $25,000 equals, you're making 34.9% interest. That's pretty good. Okay, but let's go farther. So 34.99% interest, that's pretty good. I'll take that any day. But wait, there's more. You forgot the drip at NAV. Okay, so it's not only this, it's times, we'll do an average, but 1.22, let's say, 22% NAV drip. Okay, you're actually making $10,672 a year, which over 25,000 equals you're making 42.69% interest a year. But wait, there's more. You're not including the NAV drip. I mean, not the rights offering. It tells you when to buy and when to sell. They have these little press releases. Here, watch. Announcement of right offering on 11th, 10th, and then they do it in a month in advance. May 9th. All right. May 19th, they completed it. What's it say here? It says we started it on the 16th and we finished it on the 19th. So it was 3 days, okay? So let's go over here to the stock. We'll do 1 year. Okay, what day was that? It was May 19th. May 19th. Right here. See this drop here? But you knew, okay, they announced it April 10th. Right. That's when you sell. So April 10th. So if I sold on the 11th, right? Say I sold it at 720. Let's say I only sold it at 720. And then I bought it. Now buying it, it's not, you just wait till it goes down closer to the NAV. All right, so I sold it for 720, and then I buy it, right? It's close to the NAV, so I buy it. Let's say I say, when was this? This was 421. 421. 421, and here we go. April, May, 421. Here we go. Right there. 7. No, that's not it, is it? April 21. There it is. 666. So I sold it for 725, right? And I bought it for 666. So let's say here 6.66 over 7, let's say 20 equals, so that's about 7.5%, right? 7.5% extra in addition to my, what was it, 42% interest? Yeah, 42.7%. So I sold it high, I bought it low because I looked at this, and I looked at the rights offering press release. I immediately sold it, and I'm at 720. I immediately bought it later at 666, and right now today it is trading at 833. So I made a bunch of money. So you can make, being, maybe you don't time the market, everything, 42%, 7%, that's about 50%. If you get a perfect play, okay, you don't have to worry about playing the dividend because the dividend's already set. If you just play the rights offering correctly, then you can make 50% interest, roughly, every year from a dividend that is guaranteed. In a low risk, diversified portfolio that tracks the market. And the proof is in the pudding, because this isn't even as good as it gets, because this doesn't include the NAV drip. And it's already outperformed the market by, I don't know what percentage it is, it doesn't say, but 36, 37. So anyways, the point is, if you can make, 50% is a perfect play. You time the market just right. Even if you just make the 42%, that is, if I went to a bank and they offered me 42% in a savings account, well, anyone would take that. That's free money. So, but wait, remember, we're using margin. So, with about 50%, right, if you, every dollar you put in, every year, since you're doubling your investment amount with the margin, now that's not including the margin interest rate, which for Fidelity, especially if you're under 25,000, it's like 12% and stuff, right? But it's only for the half of your money, and you're making up. So really, let's say you do a really good run, but minus the interest, margin interest, let's say you make 38%. All right. That's roughly, if I put in $25,000 times, and this is including margin, this is at the end of the day, $9,000. Oh wait, that's not right. I forgot to include my margin. I paid the margin, but I didn't have the $50,000. All right, and times 0.38. So this is including margin, debt, interest rate, and you didn't play it perfectly. You kind of, you were late to the party or whatever. You didn't buy the exact bottom. Blah, 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 blah. This is a conservative estimate, which is wild that 38% is a conservative estimate. You make $19,000 every year off of $25,000. So more or less, for every dollar you put in, every year you make that money back if you're using margin. Now, they tell you not to use margin, but with something like this, you can feel a lot safer. Obviously, you don't want to put everything into CRF, because CLM and CRF. You put like some other stuff in XDTE or some other stuff. But even if you did, it has the guaranteed dividend, so that can help you pay rent and everything. So how much do you need to live? That's how much you need to save. Let's say you need $40,000 a year to survive, pay rent, go out to eat, whatever. Well, then if you can put in $40,000, you'll get it. Let's say you start with $25,000. Okay. How much do you make? 9,000 plus 9,500. Okay, equals that. Times 1.38. So we'll do it for another year. Okay. Shoot, I forgot. Yeah. You'll make, if you let it sit for 1 year, you don't buy anything, you just let it reinvest, and then you still play the rights offering and everything, you'll make enough money to live off of. If you have $25,000, you have $40,000 within 1 year. Guess what? I have $25,000. I plan on going back to work and waiting a year. So every year, I'll make $47,000 for the rest of my life, if everything goes, good. And it resets to 21% every year. So you'll want to keep that in mind. Premium discount. See, it got as low as 10.41%. That's a good time to buy. Right? It got as high as 28.39%. That's a good time to sell. Right now it's at 22. So if you had bought it then and sold it then, my goodness. There's ways, and technically this year using the rights offering is actually less effective than, there's lots of stuff. But so you have the ability to free yourself. Oh, and this is only for Americans. Canadians don't get the drip at NAV. They can still buy it, but they don't get the drip at NAV. So, or any non-American. So much the Canadians lament, they don't get that extra special boost. But if you're a normal American guy and you can save up half your paycheck every month and invest in this, after, let's say, even 2 years, you'll be able to retire. You won't have to work. You'll be able to move to a place where it's more affordable. So you'll be able to save money in all sorts of ways. You'll be able to live wherever you want, and you won't have to worry about paying for gas to go to work or work-related cost. You'll be done. You can retire to wherever you want. If you move to like some other countries, you can live off of you can live off of $1,500 a month. If you need $1,500 a month, you can do that with this. So, good luck out there, and stay safe.